Okay, so the latest jobs report for November 2025 just dropped, and honestly, it's a real head-scratcher. It's sending some seriously mixed signals about the health of the U.S. economy. So in this breakdown, we're going to try to make sense of these conflicting numbers and figure out what's really going on.
I mean, look at this. On one hand, the economy added more jobs than anyone expected, which sounds great, right? But on the other hand, the unemployment rate just shot up to its highest point in 4 years. So which is it? Is the economy strong or is it weak? Let's dig in.
To get to the bottom of this, we've got to start with the good news. There are definitely some bright spots in this report, but as you'll see, they come with some pretty big asterisks attached.
So the headline number was a nice surprise for sure. The economy added 64,000 non-farm payrolls. That's basically a broad measure of jobs everywhere except farms and a few other places. That number easily beat what Wall Street was forecasting, and it's a pretty significant bounce back from the sharp drop we saw just last month.
But where did all these jobs actually come from? Well, if you look at this chart, you can see this wasn't some widespread hiring boom. The healthcare industry was the absolute hero here, adding 46,000 jobs all by itself. That's over 70% of the total gain. Yeah, construction and social assistance chipped in, but the big story is really just healthcare.
Okay, but for every piece of good news in this report, there's a pretty worrying number pulling in the complete opposite direction. And when you start to look a little closer, you can really see some cracks starting to form in the foundation of the labor market.
The biggest red flag, without a doubt, is the unemployment rate. It unexpectedly jumped all the way up to 4.6%. We have not seen a number that high since September of 2021, and it tells a very, very different story than those job growth figures.
This chart really shows you the kind of roller coaster we've been on lately. Just look at those wild swings. We lost jobs in August, gained a bunch in September, and then had a massive drop in October. And to make it even worse, the official numbers for those past months were actually revised downward, which means the trend was even weaker than we first thought.
And while healthcare is busy hiring, other huge parts of the economy are doing the exact opposite. Government jobs have absolutely plummeted, shedding almost 170,000 positions in just 2 months. And you can see that transportation, warehousing, leisure, and hospitality are also cutting back by the thousands.
On top of all that, paychecks just aren't growing as fast. Average hourly earnings were up only 0.1% for the month. The annual gain? The smallest we've seen since May of 2021. It's yet another clear sign that the job market is cooling off.
So why? Why all the conflicting signals? What is driving this weird mix of strength in one corner and weakness in the other? Let's try and figure out what's really behind these numbers.
Some economists are not mincing words at all. Heather Long over at Navy Federal Credit Union came right out and said it. The U.S. economy is in a jobs recession. She's arguing that the positive headline number is basically hiding a much weaker trend underneath.
And this is a really crucial point. If you zoom out from all the month-to-month chaos and just look at the last 6 months, the U.S. has only added a grand total of 100,000 jobs. That is an incredibly low number, and it really shows a major slowdown in hiring.
Now, there are a few unique things making this whole picture even more complicated. The recent government shutdown didn't just delay the report, it might have actually messed with the data, making this month less reliable. We're also in this weird climate of low hiring and low firing, where companies are just being super cautious. And on top of that, a smaller number of immigrant workers is affecting the size of the labor pool.
So what does all this mean for the folks steering the ship, the Federal Reserve? And, more importantly, for your own finances. The next few months are going to be absolutely critical.
This report puts the Fed in a really tough spot. They're basically walking a tightrope. They need to support a weakening job market, maybe by cutting interest rates. But if they do that, they risk making stubbornly high inflation even worse. It's a classic economic dilemma with no easy answer.
And to be fair, the Fed has already been pretty aggressive trying to keep things from stalling. They've cut their main interest rate 3 times in a row since September, bringing it down to where it is now, all in an effort to keep the economy from grinding to a halt.
But here's where it gets interesting. Even with all the weak spots in this report, the financial markets are not holding their breath for another rate cut. Right now, traders are only pricing in about a 24% chance of another cut in January. That suggests investors think the Fed is going to hit pause and just wait for more data.
And the experts pretty much agree. Kay Ha from Goldman Sachs pointed out that because of all those data problems from the government shutdown, the Fed will probably just ignore this report and wait to see what the January numbers look like before making any big moves.
So at the end of the day, this whole report just leaves us with this big, lingering question. We can clearly see the economy is slowing down, but it's not totally stalling out. So is this just a temporary cool down before things get back to normal? Or is this confusing picture of slow growth and hidden weaknesses the new normal?